Hello, ladies and gentlemen. This is Blair Braden, co-founder of Denver Wealth Management. Today, Zach and I wanted to come and have a presentation out to all of our clients, as well as anybody that just wants to listen to these sort of things, about the principles of long-term investing. And we're really excited to have a guest speaker help us with the presentation today. We're going to be welcoming in Geoff Sweezy from MFS Investments. Geoff is the associate managing director at MFS Fund Distributors. If you haven't heard of MFS before, MFS is a mutual fund company. They actually started the very first mutual fund in 1924. And Geoff is, again, a partner of ours. He gets to meet with all kinds of different financial advisors and investors. So you're not going to just have Zach and I's take on this, but you can have somebody who gets to hear from all kinds of different investors, his take on it. Geoff graduated from Northeastern University in 2005. And again, he's a great partner of ours. Thank you, Geoff, for having us today. And with that, let's get into the presentation.
Yeah, thank you, sir. Appreciate it very much. And guys, thank you for having me as your guest. It's a privilege and an honor. I appreciate it. Yeah, so MFS created the first mutual fund in 1924. So we've seen it all, right? Pre-Great Depression, we've seen every bad and good market out there. And I think that lends to what we'll talk about today. So today's topic of the 10 principles of long-term investing resilience, I'm going to go through the top 6. Just for the sake of, I think they're the most powerful ones. In addition to that, just for the sake of time and kind of getting it through, but we're always welcome to add the other ones at a later date or get them out. So I think before we can talk about what are those top 6 principles, we have to think about what causes an investor to not practice them, right? And so if you take a look at slide 3, you will see a word cloud of all these different words, kind of fearful words, if you will, that we get hit with every day. Things like credit crunch, financial crisis, stocks tumble, crash. And these were all kind of put out there probably, when we built this presentation a little while ago. Some of these are not in our face today. And I would say there's new words that need to be on here, like coronavirus or COVID-19 and unemployment and all these different words. And so the reason people don't practice these principles is, frankly, fear tends to overcome us. And so when you think about what causes you to stop, it's not having a discipline, letting fear or emotion get the best of you, not having guidance and help. And so every single day we're bombarded with this stuff in our face. And so on slide 4, we talk about kind of how our life has changed. If you think back a long time ago, pre-2000, you would essentially get your media, your news once a day, right? Whether that was the newspaper on your doorstep in the morning or maybe the evening news that night. You'd maybe watch or read the newspaper for an hour of the 24-hour day. And whether it was good or bad news, that was your dose of the news for the day. And then you could go about your business and go about your day. It was a lot easier to deal with complicated things, fearful things, and challenging things, because if you did it for an hour and then had the other 23 hours to maybe decompress and wrap your head around it, you could approach it a much more logical basis. Today, though, on the right side of the screen, we get our news every 5 seconds, right? It's on phones, computers, TVs. I mean, it seems like it's already just plugged into our brain. So there's no ability for you as an investor or just as a human being to kind of step aside and say, time out. I need to digest these things. There's new headlines that pop up every second, right? I mean, you go onto social media or news feed, and 5 minutes later, all the headlines are totally new and new fearful things. So these are the types of things that derail us as investors. And so I think this presentation is extremely important to kind of bring us back full circle to how do we start practicing these things. So, let's just dive right into it, and we'll go into the first principle, which is understanding market movements, right? We know that markets move. They move up, down, sideways, flat, crazy different directions. And so on page 6, this is a chart that is showing you each calendar year, and then we take the market, so we use the S&P 500 for this example, and the bars are showing you where the market finished for that calendar year of return. The dots, the little blue circles, is showing you the intra-year low point, So the dead lowest point of the year. So if you look at a year like 2009, market finished up 23% that year. However, if you look at the dot in 2009, it was actually down 28% at one point that year. How many people do you think got out at the down 28%? Now, keep in mind, let's think about what was going on in 2009 and what the world was like. Well, we were in the Great Financial Recession, which had started in actually October of 2007. So we have been in it for over 12 months, which is a very long time. The year of 2009 starts, people probably are crossing their fingers and saying a couple prayers that it's going to start different. All right, new year, new us, it's going to turn around. Markets don't really care about a year, right? So you go through the first quarter of that year and it's continuing to go down, people panic. And they say, that's enough. I've done this for 12, 13, 14 months now. This thing's never ending. I'm getting out. Those people that got out missed on that 23% up, right, for that calendar year, and a big part of growing their portfolios back. Now, the dead bottom of the market was March 9th of 2009. That was a Friday. So you really just had to kind of grind it through the first quarter. So I get what you're probably thinking is like, okay, Geoff, that's fine. But the reality is 2009, who cares? What about 2008? Well, 2008, the market was down in that year 38%. Okay. Not good. I'm not meaning to say that's good at all. But if you look at its intra-year low, it was down 49% at one point in the year. Those people that got out then missed out 11% difference. And when you do math on compounding returns, to get 11% back, you need to actually get closer to 13, 14, 15% on the upside. And so whether we look at a year like 2009, where the market finished up very high, or we look at a year where the market was down big and also finished down big, there's still an 11% difference in those down years. And what it does is it makes it very challenging when you try to get out at the wrong time to when you should get back in. And I would give you this year as an example. It's not on this chart because this is through the end of the year, but 2020, the S&P right now is down about, I think, 16, 17% as of the 9th of April. On March 23rd, it was down 30%, right? We had a massively fast decline in the market, and we've seen a really good recovery. Does that mean that we don't retest the new lows or we don't stay here for a while? I don't know. No one can tell you that. Anyone that does is frankly just making it up. But the reality is a lot of people probably left the market on March 23rd of this year, down 30%, and missed the ability to recover almost half of those losses in the last few weeks. So the reality is the biggest, principle number one is you got to understand how markets move, and that we cannot judge a market's performance on St. Patrick's Day, on Memorial Day, on Labor Day. We can only judge a market's performance for that given year on December 31st. That's the end of the year. So we can't annualize this too soon and miss on the upside.
So Geoff, have you?
Oh yeah, go ahead.
Yeah, have you seen any advisors or investors be able to have a practice that's repeatable, where they can sell before these big drops happen, and then buy again once things have fallen?
I've met with thousands of advisors over the years, and I can count on one hand the people that will tell me, I had clients, none of my clients lost money in 2008. And that's either a lie or they just had a bank account in cash, because there's no one out there that can see it. I mean, I look at MFS as the firm that invented the mutual fund, managed through the Great Depression, every boom bust cycle since then. We have over 300 investment professionals located around the world in our global offices, and we would never claim that we can figure out when to get in, when to get out. Nobody has that crystal ball. Anyone that has done it based on luck, and then they've kind of tried to sell it as hey, we did this once. There's no repeatability to it. And I think as we go through some of these slides, you'll start to see that the best chance you have is time.
You got to know when to sell and then when to buy again, which those are two very hard decisions to make.
Totally. So if you take, actually, this is a perfect example. If you put money in the S&P 20 years ago, and this is as of the end of the year, but it would grow to about $40,000. If you put $10,000 in 20 years ago, it'd be about $40,000 today. Okay. If you miss the 10 best days in the market, it would only be worth 20,000. So that's 10 out of 3,000 and something days you had to get right. You ended up with half, right? So I would tell you, I can actually probably help you figure out when the best days in the market are, because they usually follow the worst days, right? Markets sell off huge, smart investors buy, end up with big days. We've seen it in the last month, right? So we're halfway there to figuring this out. Here's the problem. I can't for the life of me, and no one can tell you when the 10 worst days will be. So we just can't time it. So we go to second principle on volatility being normal, right? And so on slide 8, this is I call it buy low, sell Y. Instead of sell high, sell Y. Assets grow over time. So on this chart here, we're just taking the Dow Jones Industrial Average, looking back to 1940 and charting out the up markets, so the bulls, and the down markets, the bears. The ups we color-coded green, the downs we color-coded red, right? And so as you can see in the green box there, it'll show you the average bull return is around 150%, and it usually lasts around 4 years, okay? And your average down market is usually down 31%, lasting about a year. That tells me that markets go up about 75% of the time, right? Now, here's the thing that most people I think know, is that the pain of a loss is 10 times greater than the joy of a gain. So while that down market is not as big of a down number as the up number, the years are not as many, the pain of it feels a lot heavier. And so it makes it very challenging. But if I were to take a ruler and draw a line from that first data point on the left, 1940, to the end of last year, the 31st of 2019, what direction does that line go up? It goes up, right? The problem is it doesn't go up in that linear fashion. Markets are not linear, so therefore we don't behave linear. But if we can step back and we can lengthen our time horizon, we can do a lot better job of seeing these markets. Now, no, it's not easy to do that, right? That's where the emotional piece comes into the factor. But the reality is that if you look at these green bars, they're a lot longer and they're steeper. They're going up more than the red bars. It shows you that money goes up over time. If there's one way to think about it, an analogy that I heard I thought was fantastic was when you watch the market every day, which a lot of us do, and you're watching the ups and downs, right? And the jagged sawtooth that this looks like. It's like watching someone go up an escalator with a yo-yo. You're watching the yo-yo the entire time, but you're not watching the progressive upward movement overall. And so that's what happens when you shorten your time horizon. You look at the yo-yo. When you lengthen it, you're looking at the entire escalator of the market going up. So volatility is totally normal. It happens. A lot of times it happens so fast in quarters that people don't even realize they've lost money because it's rebounded so fast in that next quarter. So we have to be able to wrap our arms around volatility being a totally normal thing and not letting it get to us. Number 3, the third principle here is taking control of your emotions.
Hold on. Maybe one quick question before you go on there.
Yeah, I apologize.
No, you're cool. I get it that volatility is normal, but this one's got to be different though, right, Geoff? I mean, this is something we've never seen before. The economy is obviously going to be hurt real bad, we all think, through this. So I mean, this time's got to be different, right?
I would say this time is different. 100%. You're right. It is different in the cause of this recession. What is not different is what the impact will be and what the recovery will be. If you go back and look at every recession we've seen, they've pretty much every single one of them have been caused by something different. We really haven't had a repeat, right? The 08 was subprime debt and lending crises in the housing market. Early 2000s was tech companies. You've had oil, right? So you can go back in history and find a recession with a different cause that's never happened. The impact has kind of always been the same. companies lose earnings power. They do not grow and they start to dwindle. Therefore, people start to lay people off and unemployment spikes. People do not spend their money and the economy suffers. The biggest drivers of the U.S. economy are us folks on the phone, are the American consumer. We drive 70% of economic growth. So to your point, Blair, if we are at home, work from home, and restaurants are closed and all these things, and we're not spending the money like we are, yes, this is totally hurting the economy because the biggest driver is not out there spending their money. As we find some type of floor to this market, and how we find that floor is many different things. It could be valuations become so darn low that people just put in a floor and start buying. It could be we find a vaccine or a way to treat COVID-19, and it could be the cases start to fall. But even then, I don't think it's an overnight floor, right? I think we could sit on the floor for a while until we start to see businesses reopen and all that. But in that case, in that scenario, in that kind of middle cycle where we find that floor, bad companies will go out of business, good companies will survive, great companies will thrive. That happens in every single down market, and every time there's that big, long, bullish recovery, which you can see on the chart that we had showed. So I think you're right in that it's different from the cause. What is not different is the impact in the recovery will be what we've seen before. Because there always will be winners and losers no matter what's happening. Does that help answer that?
Absolutely. Yes. Yeah. Thank you very much.
Awesome. Cool. And so third principle, emotions. My favorite, right? People are emotional creatures. I think we all know that. And what this chart is showing you, and I apologize, I wish the colors were more contrasting. They're kind of two shades of blue, but the blue line graph, the tealish line graph, is the S&P's total return over time. So we're going all the way back to 1998. And then the blue bars is the amount of money being invested into the market. So here's what I want you to know. These two lines should be operating in the opposite of each other, right? It's buy low, sell high, not buy high, sell low. The problem is human beings, because we're emotional and we get bombarded with all this news and craziness, our emotions take over and we do the wrong thing at the wrong time. We sell low, we buy high. So if you take, for example, a year like 2003, you can see that at the S&P peak there is also the same exact time that the most amount of money is being invested into the market. And prior to that, or you can go to 08 when they're in their biggest drawdowns and the biggest down point, is when the most amount of money is being taken out of the market. This is supposed to be backwards. This is the chart that's don't be that guy. Don't do what these people are doing. However, people feel better when they're wrong together. There's something about a crowd mentality like, oh, everyone else is doing it, so I'm just going to get out, or I'm going to buy now. It's really hard to be that one that bucks the trend, but the one that bucks the trend tends to usually be some of the best investors. You look at a guy like Warren Buffett, who we all know and have all studied. He's always said, when there's blood in the streets, I'm buying. And I bet you right now he's buying, right? And that's what smart investors do. Now, all the way to the right, you can see in the last few years, the chart has actually started to behave, or people have started to behave, and not be selling or buying at the top and chasing these returns. I can promise you right now, when this chart gets updated through this year, that will it's going to go back to normal. We've seen it in the industry flows that people are selling out because it's low and they're bailing on the plan because their emotions are winning and getting the best of them.
Hey, Geoff, I have a question for you that I know some of my clients would get if they were on this call. It's one thing to look at a chart like this, and it's another to see let's say you're 65 and you have $1 million invested and half of it's in stocks. To see your $1 million go from, let's say, $1 million to 800,000, that's money you can't earn back if you lose it. So looking at a chart like this might not be too helpful in the moment. What tips do you have for someone in that situation to try and control those emotions and try and make the right choice when every day it seems like their accounts are going down more and more?
Totally. The easiest tip everyone always says is just don't look at your statement. The reality is that's extremely hard to do. People are going to do that. I think knowing you guys for as long as I've known you and worked with you now for 10 years, I know you guys have it set up right where you got people with long-term money, medium money, short-term money. If you've got your short-term expenses, it's 2 years, it's 3 years, whatever it is, covered in a secure blanket like cash or something like that at the bank, I shouldn't get concerned of what my long-term money is doing. So if I'm 65 and I'm hoping, I retire for 20 to 30 years and I live a great long retirement, and I have my short end of my bills kind of set up for the next 3 years, I can breathe a sigh of relief because I know the average bull market only lasts 1 year. So if I'm good for 3, then heck, I should be all set. Now, how do I also keep myself from looking at it? And if I'm taking money out, if I have my plan set up correctly and the money that's coming to me every month is consistent and doesn't fluctuate, so I'm not, getting $10,000 one month and then $2,000 and whatever the dollar amounts might be, and I can ignore the account value, I know over time it will recover with the bull market. So the biggest tip you can do is bucket your money, set it up strategically over time, and don't make a short-term decision with long-term money. That's fine in your short-term bucket, but in your long-term bucket, don't do it.
Oh, that's a good way to say it, is don't make a short-term decision with long-term money. I love it.
That's a big, big mistake. So, awesome. So, next slide, fourth principle, taking a longer view. We've kind of talked about this, but I think this shows it even better. So what you're looking at here is the S&P 500, and then the percent of time it either finished positive or negative. So the first bar is showing you of all the 1 year time frame from 1951 until 2019, the S&P has finished in an up number 74% of the time. If we were going to Vegas and betting at a blackjack table and we had a 74% chance of winning, let's just say Vegas wouldn't be there, right? The casinos would be broke. That would be a broke business. In the market, you have a 74% chance of winning any given year. However, nobody actually invests for usually one calendar year, right? We tend to invest for a lot longer time frames. So step down to 5 years. Our chances of a positive number go up 82% of the time the S&P is up on any given 5-year period. 10 years, it's better. 20 years, it's 100%. So we could sit here and cherry pick time frames. We could say, show me December 31st, 1960 to December 31st, 1980. It's positive. June 2nd, 1980 to June 2nd, 2000. Positive on a 20-year basis. No matter how you try to cherry pick it, 100% of the time the market has finished up in that 20-year time frame. You're lengthening your time horizon, which I talked about earlier, is the biggest key to your success, and that's that long-term bucket. Think about it from a standpoint of grades, right? The 1 year at 74%, that's a C. That's a passing grade, right? 5 years is a B, 10 years is an A, and in 20 years is an A++. You're valedictorian, right? I can tell you, I wish I could have given myself grades in high school and in college. As an investor, you have the ability to grade yourself. Pick the grade that you want. Do you want a C or do you want an A++ and be the valedictorian? If you want an A++ and to be the valedictorian of our investing class, you have to look out longer time horizons. It's the only way to do it.
From this part of your presentation, I mean, it just goes back to what you said prior to the prior principle as far as bucketing your money. And like you and Zach both said, not making short-term decisions on your long-term money, but by having that bucketed money approach, you're allowed to have some money take advantage of this longer time horizon while still taking care of your short-term needs and goals. To give you that, I mean, isn't that the way to give you the best chance to get that A++ with at least a portion of your money, is by having that strategic bucketing, financial planning based approach?
Totally. The bucketing thing sounds so simple, but it's probably the most powerful tool we have because you hit the nail on the head with. As someone that has some dry powder on the sidelines and you're not worried about your long-term money, you can pick up some really good companies at a really good discount and increase your chances of that A++ grade, right? When you think about what most investors are facing today, is they are sitting here panicking, saying, what am I going to do? And they have a fear. The people that are built it the right way, like we're talking about, are sitting here waking up every day saying, what am I going to do? And they have a fear. The people that are built it the right way, like we're talking about, are sitting here waking up every day saying, what am I going to do? And they have a fear. The people that are built it the right way, like we're talking about, are sitting here waking up every day saying, what am I going to do? And they have a fear. The people that are built it the right way, like we're talking about, are sitting here going, waking up every day saying, What opportunity do I want to take advantage of in front of me? And that's a totally different mentality and a heck of a lot nicer way to live life, right? So,
oh, absolutely.
I'd take to the sixth principle. This is something we've talked about for a billion years, and this story is never going to get old, on diversification. Slide 14, it shows you that from 2000 2009, it shows you different asset classes in the market and what their returns were each given year. If you take a look at that black box in the middle, that's a diverse portfolio. So that's just an even mix of all the other asset classes you see here, which is actually not typically how you build a diverse portfolio, but it's just a simple example. And what I'd ask you to note is, try to find how many times that black box is on the top of this chart. It never is. But the important part is that it's never actually on the bottom. It's actually mathematically impossible for it to be on the bottom. I'd also tell you, if you were trying to pick asset classes, winners, losers, whatever it might be, you might win, right? You might win over time. But I bet you had a lot more stress, anxiety, and ulcer getting it because of the ups and the downs and the crazy swings. That black box going across the middle is a very smooth path. I don't want my retirement account to be a roller coaster at Busch Gardens in Tampa. I'll do that for fun. I don't need to do that with my retirement money. I want a nice, easy Sunday drive, right? If you flip to the next slide, it shows you from 2010 to today. So you had a flat market from 2000 2009, and then 2010 to today, you had one of the best bull markets we've ever seen in history. Again, diversified portfolio right there in the middle. And on the far right, you can see the average over the last 20 years. Diverse portfolio finished in fifth place, dead center of the chart, consistency over time. And as investors, all we're trying to do is be consistently good, not occasionally great. And that's how you're going to be better off. But if you go to the next slide, this is a different way to look at diversification that I don't think anyone has ever really looked at or presented. But diversification can be loved and it can be hated. In fact, it's the discipline to own the things you don't like. And advisors are the one that help us do this. But on the left side, if you look at years 2000, 2002, take the S&P 500 was down 37% in that time frame. A diverse portfolio was only down 14. Okay. So naturally, a financial professional would say something like, hey, we did better than the S&P. A client's logical brain will tell them, but I still lost money. It was still down, right? So then you go to 2003, 2007, S&P is up 82%. A diverse portfolio is only up 57, lags a little bit. A financial professional would say, hey, we participated. Client says, but I didn't get as much as the S&P. And we can dance back and forth, right, through each one of these years. But if you look at 2009 to 2019, the S&P in that 10-year time frame was up 351%. And a diverse portfolio was only up 200. That's 150% difference. That is humongous, right? So you might say, I gotcha. This is where I can prove to you that diversification doesn't work. 150%. There's no way diversification made up for that. Well, if you take the entire time horizon, right, by lengthening it 20 years, the S&P was up 197. The diverse portfolio was up 206. Even though we didn't get 150% of that great bull market, diverse portfolio still beat it. There is no question that diversification is the discipline that will help you succeed, especially when you're lengthening that time horizon. So then 10th principle, one of my favorites, just working with a professional, right? Having a team, having Denver Wealth Management as folks that can help you manage each of these things that we've talked about, these principles, right? To practice each principle on your own is very challenging. And I think everyone needs a little bit of help. But the way I want you to think about it is I travel a lot for work. Well, not currently, obviously we're work from home, but historically I travel a lot for work and I get on a lot of planes. When I go to DIA and I board a plane, 100% of the time when I walk into that fuselage, I turn right. I have never turned left. There's only two people that turn left, the pilot and the co-pilot. What we are on as investors, when we're lengthening our time horizon, is we are on an extremely long flight. We're who knows where in our flight. It depends where you are in your investing career and close to retirement and all that. But we're somewhere in the middle of a very long flight, and we have just hit the worst turbulence and volatility and storm that we've ever seen in a plane. If I'm sitting in the back of that plane in seat 15C, and everyone around me is gripping the armrest so hard they're about to rip them right off the seats, I don't think anyone in that cabin is thinking, that's it, I'm taking over flying this plane. The pilot and co-pilot can come sit in the back. This is not the time to get rid of the pilot and co-pilot. And I would argue there's never a time to get rid of the pilot and the co-pilot, but right now is when we need them the most. So if you go to the next slide, our last slide, I think that shows this. What we're looking at on the last one is the S&P 500 as the equity index for this test, and the Barclays Ag Bond Index as the other. And those are the dark blue bars. So the S&P 500 returned about 5.62% on average over the last 20 years. Barclays Ag returned about 4.55 on average the last 20 years. The average stock investor only got 3.8, and the average bond investor only got 0.22. Why do you think that is? I can tell you right now, it's because they didn't practice the principles. But the most important one is this 10 point is that they didn't have someone to make them do it. And so the importance of having the principles is strong. The importance of having the coach or the pilot and the co-pilot can't be emphasized enough. So that's kind of the end of my prepared comments, and I'll hand it back to you guys and just say thank you for having me on and having me as a guest. I truly appreciate it.
Thank you, Geoff.
Yeah,
Absolutely.
You, Geoff.
Yeah, and if you wouldn't mind, maybe just because we are in this environment, and we really appreciate what you told us, and I think, Zach and I in Denver Wealth Management, we agree with everything that you just said there, and we're happy to discuss this further with any clients or non-clients that would like to chat about it. However, would you mind giving us just kind of a quick, what does MFS, where do you guys envision we're at in this cycle, and what is the next 6 to 8 months, a year, kind of look like from MFS's perspective in terms of investing?
Yeah, I think we're still early stages, or we think we're still early stages. It's too soon to say, hey, this is the bottom, right? There's so many still unknowns. We don't know how to treat or prevent this virus that has caused us to all stay home, which is having monumental impacts on the economy because people are not out spending their money. We are doing a good job of self-isolating, and you've seen numbers improve and death tolls have increased in New York, but you're seeing the curve maybe is starting to get flattened a little bit. Is it getting flattened enough? We don't know. You don't know till really at the end of this. The other thing you don't know is when this is lifted, what happens? Does it spike back up? And do we need to go back home, or do we do a good job of finding some balance in the middle and prevent that from happening? And even if we do kind of find the bottom right now, it has happened so fast that I think there's a lot of poor companies and businesses out there that are making it by, but maybe when the economy doesn't recover in a V shape, so not a super fast recovery, but maybe a slower U shape, they can make it by for a little bit, but it might get too long of a time frame for them to succeed, and they might end up going out of business down the road. And so there can be that kind of later second wave of economic impact because the leverage they've had and the debt they've had is just too much that they can't survive. And so we're still very much cautious. Now we find opportunity every day, and we're fortunate to be able to do that. But the reality is we think there's a lot longer to maybe retesting lows or just staying where we're at, but this isn't about to go spike up and finish the year positive, I think, on 2020.
Sounds good. Well, thank you so much. We really appreciate your time today and MFS's support and the very exceptional job you guys do of being great stewards of our clients' money when we trust you guys as we buy your mutual funds and different sleeves of that diversified model. And so we thank you, MFS. We thank you, Geoff. Zach, you got any more questions for Mr. Geoff here before we let him go?
No, I appreciate it very much. I think that's, a lot of what people in the industry are thinking is that, one thing we've been saying is that the coronavirus is new, but bear markets aren't. And, we don't know exactly how this is going to play out, but we know that this isn't going to kill the entire world's population, and we'll get through this. And I think people who are brave right now when the market is a little bit scary are the people who are going to make the most money in the end.
Yeah. Thank you guys again for having me.
All right. Thanks, everybody. Again, Denver Wealth Management. Please follow us online. We're on Twitter. You can listen to our podcast. You can follow us on Facebook. But we're all working. We're all available. So if you have questions, you want to chat about this presentation or just in general other things, please don't hesitate to give us a call. Shoot us an email at denverwealthmanagement.com. You can find all of our contact information there. Thank you very much. Everyone have a great day.